Alright, how's it going, everyone? This video here is just going to be a market terminology and just a rundown of what everything means. So that way on these future videos when I'm kind of going through and describing what makes something a bad or a good setup, you guys understand the words that I'm saying. So right here we're going to look at some crypto, some Bitcoin. We're just going to start off with the basics. So first of all, here's a low clearly, right? There's a high, and then we have a to here, and then it goes up again. Okay, so this would be a low, right? That'd be called LL for lower low. Okay, let's see, that's a lower low, and then you see here we go up, that's a higher high, higher low, higher high. Okay, and then going down would be pretty much the same exact concept but backwards. Okay, so here we have a higher high. From here we have a higher low, higher high, higher low. Okay, now to clear all that is to kind of give you an idea of just some market structure. That way when you come through and you use something called liquidity sweeps, you understand what you're looking at. Now liquidity sweeps are one of the most important concepts no matter what strategy you use to trade, because it gives you an idea, a good hint on a reversal, if that makes sense. Okay, so for example, let's say, let's come over here. Okay, so I don't really like what this looks like, so we'll come over here. All right, this is perfect. So screw all this here. Let's say we're right here. We come in, we're watching it. Boom. We sweep this high. Look what happens. We get a reversal. Okay. Boom, we come in here. We sweep this high. This high sweeps this high. We get a reversal. We come up, we come up. We sweep this high. And we already have a downtrend forming. Okay. Now, obviously, none of these concepts have a 100% rate. I mean, otherwise, it would just be guaranteed. But these are all just confluences that can give you an idea of where the market's going to go. They give you better probability to know where to place your money. So if we come in here, we sweep this high, it'd be the same thing going the opposite direction. So look at this right here. We came here. Look what happened. We came in here, we sweep this low, and look what happens. Boom, goes all the way up. What's that called? Liquidity sweep. Okay. It's pretty simple. I mean, you can kind of go through the whole market and look at big spikes up and down, and you'll see it nonstop. Okay. No matter what you trade, what strategy you trade, I trade ICT concepts. You're going to see 9 times out of 10 people use liquidity sweeps to their favor. Okay. Now, my bread and butter is something called inverse fair value gaps. Okay. So we're going to come in. For those of you that don't know, I'm basically explaining this video for as if you were in kindergarten. For somebody that doesn't know a damn thing about trading. First of all, a fair value gap is just 3 candles. So 1, 2, 3, and the gap in the middle of them. Okay. So as you can see, here's a candle. Here's another candle. And here is another candle. Now, typically you do wick to wick. If the candle doesn't have a wick, then it's wick to body. Okay, see that? You can't have a fair value gap off 2 candles. It has to be 3. Same thing coming down, same thing going up. What doesn't a fair value gap look like? This. And the next one is like right here. Okay? There's no gap between the first and the third, the first and the third. Okay? So some people use fair value gaps to their advantage. Most people do. I trade the inverse of that. Okay? So when we come down here and we create this gap, that's our fair value gap, right? Okay? I trade inverse. So that means the opposite. So basically we're going to come through and we're going to, hold on a second. We're going to inverse that fair value gap. Now, key component. Notice how this candle did not close, the candle didn't close above the fair value gap. So I'm not going to take my entry yet. You want to wait for that candle to close like this. Typically like this is what you want. A good strong V momentum up. Okay, breakthrough. That's what you want. And then I'm looking at getting longs here. If this was the opposite, let's say something like this. We would come in and we would trade the inverse of the opposite direction. Okay. Boom. I'd go for shorts. Okay. Same exact thing, opposite directions. That's the cool thing about day trading, guys, is the market can go up or down and you can capitalize on that. You want to wait for a close above that fair value gap. Don't forget. Now, when you combine this with liquidity sweeps, it's pretty powerful. Okay. So for example here, look what happens here. We come in, we sweep these lows here, and look what we get. Came in, we sweep these lows. What do y'all notice in that same thing? We have a fair value gap. It closes above, strong V up, and look what you get. You get a huge push to the top. I mean, you can look at all these. I mean, sometimes you just go through the market and look at all these ups and downs, and most of them have a similar case to this. Now, if I'm on 1 minute time frames, that means each candle is 1 minute. 2 minutes in, it's the next candle. 3 minutes in, it's the next candle, so forth. So what you see is multiple fair value gaps on top of each other. So I would just go to like right here. Because if I were to go to the 5 minute time frame, it would pretty much be just one fair value gap. Or one joint candle. Does that make sense? So you want to wait for it to break above this. Because then, let's say you're here, you just have this candle fighting against all these fair value gaps. So you want to go to the top. If you have multiple on top of each other, of course. And you want to wait for it to break that. Okay? Even if you were to get in here, which sometimes can be too late, because, I mean, that's a huge jump right there. I would have been targeting these equal highs. All equals highs is two bodies that are the same height. They have a strong draw on liquidity, and that can usually be your target. Let's see where this one stopped. Exactly. Look where this one stopped up here. Two equal highs right there. Okay. They're good things to target. If you're not targeting equal highs, you should be targeting fair value gaps for your take profits. So we went through liquidity sweeps. Fair value gaps. Keep in mind we trade the inversion of that. Okay, so prime example. Now, the few things left to make something an A+ setup. These two here, you have this. I call that like a B setup, B+ setup. Okay, something you can take. But if you want to minimize risk, you need to be taking as many A+ A setups as possible, which means you're not going to be trading all the time, which is good. That's healthy. That's smart. Next thing up is what we call, hold on. We're going to call it a rejection. Okay. a rejection off a fair value gap. Now what that looks like is, look at this right here. Okay, prime example. This is a perfect example. We come down here, right? And what happens? You'd say, oh, it stopped here and went back up. Yeah, okay. Well, look, notice where it stops. It rejected off this fair value gap right here. 1, 2, 3 candles, fair value gap. Now, typically, I like to look for a different time frame for value gap. I don't know why. It just seems to have more strength, which it still did. It's good to see. Comes in. Look for rejection of a higher time frame. 3 minute. That means each candle is 3 minute. Then you go back to your 1 minute and look for an entry. And if you notice, it's still inversed. So we got a rejection. It inverses. We would have got in, came here, whatever. We hit traded consolidation. Didn't do too well. But just a prime example. You would have went up here. You still would have, what, you capitalized on 440, 300 points, guys. Okay. One contract of a future is $5 to $10 times 400 points. You know, that's a good little move you just made right there. Off not much. So rejection. Okay. Now, if you notice something about confluences, which are basically just everything I'm giving you, all these ideas are just, in other words, confluences that are all leading to the same direction of change. Okay. So the liquidity sweep signals a reversal. Boom. Comes in here, sweeps this low, this wick here, sweeps that low, signals a reversal. Had the inverse fair value gap, signals a reversal. And let's say the same trade, we had a rejection somewhere over here. A reject, it's also going to signify a reversal. Okay. I hope you guys understand that. I'm trying to keep it as simple as possible, as dummy proof as possible. So the last and final thing that you need to make it the best setup you can possibly have, it's called SMT. What SMT is, keep in mind, guys, I trade futures. Okay, I don't trade crypto. I practiced on crypto. I spent a lot of time learning on crypto, but I trade futures. What that means is, if you trade futures, you probably trade NASDAQ. Okay, futures, if you're somebody who's getting into trading, you don't know what instruments you want to trade, cryptos, forex, futures. Futures has one of the best schedules. It's one of the simplest ways to get in and get out. They have a lot of firms, so you don't even have to put a lot of money in yourself. And you can buy a contract instead of putting a lot of money in, and you only trade one or two different things every day. Instead of crypto, you'd be trading Bitcoin, XRP, all these other things. Futures, you wake up, you trade NASDAQ, you get off. That's your day. Boom, cash out on what you cashed out on. So an example of what SMT is this right here. Okay, so basically, I can't because I don't have the premium of this. But NQ, which is NASDAQ, and here we're gonna draw it out for y'all. So NASDAQ and ES, which is S&P 500, they're almost identical on the chart. Okay, like literally almost everything is identical. Let's say this is NQ right here, which stands for NASDAQ. This over here will be ES, which is S&P. Okay, this is called SMT here. It's fairly simple. So notice how you have it comes here, it goes up, comes here, and we take out that high, right? So that's a liquidity sweep. Okay, we take out that high with NQ. But let's say we come here with the ES and we don't. We go back down. We don't take out the high. Well, that would create something called an SMT. Which, guess what, guys? Also signifies a reversal. So if you can get something like that, okay. where you have SMT. Where's it at? Let me get there, guys. Okay, there we go. If you have SMT, like for example, let's see. Let's say this was NQ and ES, and ES didn't take this low out, but NQ obviously did. Well, that would be a SMT right there. That would be a liquidity sweep because we took out that low. That would be an inverse fair value gap. Keep it simple for the 3 candles because you guys probably don't understand yet. Be inverse fair value gap. Okay, so we have our SMT here. We have a liquidity sweep here. We took out that low. Okay, SMT, liquidity. We have our inversion fair value gap because we have our fair value gap that got inversed. Oh, you dumbass. Okay, what's left? The only thing I don't have here is a rejection off a higher time frame or even the same time frame fair value gap, which here's a prime example of that. Comes down, rejects, goes back up, had an inversion off of it as well. That's pretty much the most basic way I can explain all this. What does this equal here? A plus setup. Now, you're not going to come across A plus setups all the time. Okay. Big things you want to stay away from is huge. Like, let's say all this, let's say it was just like one candle that came all the way down like this. I would not trade the inverse of it down here. Okay. Because that means there's too much momentum going on. Like, if all this here was just one candle, let's see. I mean, and keep in mind, that doesn't mean you can't. It's just there's certain things that keep things from working as likely. Like I said, I trade ICT concepts. If you want to learn a little more about that, you can watch videos on ICT. And it's basically just a whole bunch of ideas, and you kind of pick from it what you like. I know multiple people that I've traded with, that I've studied, that use these 3-4 things, and they trade it every day like it's nothing. For futures, market open is at 8:30 our time. Market open is New York for us. So 9:30 their time, 8:30 our time, to 3:30 our time, 4:30 their time. And I would stay away from the first couple minutes of market open because it's going to come out swinging. Let it form a little bit. Let it see what it wants to do. Let it break a high or two or a low. Get your liquidity sweep in there. Try and get a rejection and go from there. If there's things that I didn't answer, go ahead and leave a question down if you can. And I'll try and make a video on that. Thank you.